Does the record length of the current yield curve inversion suggest that a recession is coming soon? Well, since early March, the U.S. Treasury curve, that's measured by 2-year versus 10-year Treasury yields, has been grinding higher from negative 45 basis points on March 6th to a current level of about negative 36. What's mildly unusual about the yield curve's move toward zero is that it's been in a bear steepener, meaning that rates across the curve have moved higher, but that 10-year yields have moved higher faster. A more normal situation where the curve is normalizing would be what's called a bull steepener, wherein all rates go lower, but shorter end rates go lower faster. This is usually caused by a Federal Reserve that is aggressively reacting to declining economic data by lowering short end rates. Now in April, we saw some cracks in the economic data, with a lower than expected US GDP number, followed by a soft labor data on May 3rd. Oddly, the inflation data has not been coming down alongside the general data and appeared to remain sticky. However, PPI on May 14th and CPI on May 15th may have changed things. Now, the PPI number came in higher than expected on the headline, with year-over-year core at up 2.4%. But last month's revisions to the series were significantly lower. Then the CPI number came out on the 15th, lower than expected, plus 0.3 month over month. Some analysts may believe that this development could pave the way for Fed eases to be pulled forward and for the curve to potentially move back into positive territory. Now, if a trader believes that the yield curve will steepen towards normal shape, they could express that by buying the CME Micro May 2-year versus 10-year Treasury yield spread contract at negative 0.34 and targeting a move to zero. A stop for this trade could be placed below at negative 0.55. This trade can make $340 if the target is reached and risks $210 if you're stopped out of your level. Now, as a reminder here, you will have 2 separate positions in this trade, and it may need to be monitored individually in order to exit at your chosen levels. Now, if a trader believes that the curve will invert more from here, they could sell the CME Micro May 2-year versus 10-year Treasury yield spread contract at negative 0.34 and target a move back to the 2023 lows of negative 1.00 or 100 basis points. A stop for this trade could be placed above at positive 0.10. This trade can make $660 if the target is reached and risks $440 if you're stopped out of your level.